Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Thursday, August the 11th, the year's 2022. Let's talk trading. How you trade, part 4 with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. Walmal, we're talking about how you trade, and you had mentioned something about my idea about, being randomly put in the trades.
Right, I recall that.
Yeah, well, it's really interesting because, so much time is spent on the entry methods. Most most methods really focus on, if this, and this happens, then you enter the trade long or you enter the trade short. But after that, usually it's like you place your stop loss here, you place your stop, and you take profit there. And as I said, when you do that, to me, that's when you place a bet, as opposed to being in there in a tick by tick fight. What's your thoughts on that?
Well, I can understand why certain traders like the idea of putting a stop, one particular place and putting their TP, in another place because let's face it, at that point in time, it's a click and walk away. So you don't have the active pressure of monitoring it literally tick by tick, pip by pip, and so I can see the allure of doing that. And there are some methods I think that are out there that that really are conducive to that idea. They're conducive to the idea that you can do that. So, for instance, you get out there and you're trading off a monthly chart. The reality is, you're not going to make your money most of the time anyway if you're trading off a monthly chart. 5 minutes after you get into a trade. With that matter, even an hour or 2 hours after you enter a trade, you may not make your money on that for 2, 3, 4, 5, 6 months down the road. Based on what and how whatever your method is trading off that chart. So that for that particular trade, it may make sense to go and put a stop loss in one place and a TP in another place, because the reality is you can't sit in front of your terminal, 24/7. Or 24/5, I guess, for the next 2, 3, 4, 5, 6 months. It's just not possible to do that. So how do you do it? Put your stop loss in, put your TP in, and hope that you've guessed right. Because let's face it, you make educated guesses. When I say guess, I'm not saying that you're just randomly picking stuff and throwing it in the wind. No, you're making an educated based guess on what has happened in the past and what the conditions of the market are. Now, even in you trading off the monthly chart, you're probably going to still go and check in, or at least you should, at least daily, and just go and make sure that it's not just totally. Okay, whatever reason for getting into the trade in the first place hasn't gone away. The market's changed that much, which can happen, very easily can happen. So I can see lend some credence to the idea of putting a stop loss on TP and walking away from it and letting it happen. And I know there are a lot of traders who make a lot of money doing it that way. And that's fine for them. It's just that the method that I happen to use, it wouldn't make sense to do that. I don't trade that way. It wouldn't make sense. I guess I could do it, but the problem is by the time I go into a trade and I actually go in and set the stop loss, set the TP, I may have already been out of the trade by the time I get all those things entered into the computer. So it may not make sense for me to do that.
Right.
Sometimes it's very difficult for me to go and get those numbers in.
Right. And it's funny you mentioned the monthly, so I pulled up the monthly chart with the monthly Walmall lines. It's like every 1,000 pips. So I could change that back to 100 easily. But the thing is, one, price just entered the launch pad at 22.40, and it's going up. The other thing is that the monthly range right now is only 290 pips. And when you look at the last, you're looking at 12 months worth of ranges. The lowest one here is six months ago at 371, and then there's a 389 and a 390. So looks like we've got close to 100 pip to go, and there goes the price in the launch pad. Did you take that trade?
No, I did not.
Yeah. That's right. You said you were done for today.
Yes, sir.
But anyway, it's just one of those. It's just interesting. You had talked about the monthly, so yeah. If you like to trade off monthly charts, it definitely looks like price needs to go at least another 100 pips in range. And since it's it looks like let's see. How far is it off the bottom? Let's see. We can show close to low. It's 243 pips off the bottom. So if it's going to put in the range, it would have to move a nut 243 plus just to extend that range to the downside. Now to the upside, if we do high minus the close, we've only got 48 pips. So smart money, I think, says if this is going to hit that range, it's going to go up from here.
Right. It would make sense that we'd probably do that. But, getting back to what I was saying, now for me, because of the way I trade, it's just easier just to monitor it and, take the pips when I see them. Now, you said an interesting thing. What was the range on that monthly?
Was current is like 290.
And what was last month?
Oh, last month
Something, right?
Last month's range was 486, and
Okay.
and before that was 683, 511, 756. So yeah, it's been in the over 370 for the past 11 months.
Right. And here's what I was trying to get to. Our daily ranges have been, well, yesterday was 211, which was a little bit of an anomaly. The day before was 67. The day before that was 90. And 2 days before that was 166 and 150. Okay, so what I'm suggesting is that you potentially, on a daily chart, you're seeing ranges that are, a third, of what the monthly range is. Well, to me, that tells me that there's more opportunity in the daily because what's probably happening in the monthly, I'm not looking at a monthly chart right now. I could put that up. Is that what it's going to do is, if you were to go and take that monthly candle, okay, yeah, it shows a candle of, 200-300 pips. That's great. But when you go and then you have to go and remember that candle is composite data of all the days in between. There's 20 days usually in a typical trading month. There are 20 days where it goes up and down. So there's lots of ranging that happens within that big candle. My point being is that, for me anyway, it just makes more sense to go and trade, off of a much lower time frame. And the reason why is because I can get almost as many pips, and trading on something smaller with a lot more opportunity to get in. Hopefully what I'm saying is clear.
Yeah, well, at least I understand it. Because I think basically what you're saying is, price is going to go up, price is going to go down. And when you look at it, say on a daily, and then you compare the daily range to the monthly range, there's going to be a lot of, ranging within certain bounds as opposed to, just a move in one direction. So it might, so it might make a new high of 10 or 20 pips, but then it might come back down, then it might make a new low of 10 or 20 pips. And you can see that on the daily chart, how price is going to do that ranging. Since the monthly open, it put in a high, it came down, put in a low, and now it's coming back up and it's closer to the high.
Right. Exactly. And because of that, you know that what's going to happen is that price is going to travel like that, because that's what it does. It travels like that. So the potential of just putting a stop loss in one place and a TP in another place, the problem with that is that potentially during the travel, yeah, it may go up. Price right now is basically 22.42. Okay. And let's say for whatever reason, you were looking at that monthly chart and you say, you know what, it's got to hit 2,400. So you're going to get yourself, basically you're looking for 160 pip, profit. Well, the problem is to get there, it may go down 150 or 200 or 300. Yeah, your analysis was right, but the travel is going to cost you getting in and out of that trade. And a lot of these guys, do that, of 1 to 2 type of risk where they risk 150 pips because they want 300 pips. Well, the problem is sometimes the travel is more than the reward can potentially give you. But that's part of the game that they play, and they can make money doing that because they put in the homework and do it that way. To me, it's sort of like, well, what I'd rather do is I'd rather go down and trade the minutia of that, knowing that on a typical day, I know that you had looked at this a while ago, TRO, but there was in a particular day, you're going to in a particular day, you got a good chance of actually having more travel than you actually have a range of the week. That's my guesstimate, but I'd be willing to bet that that's probably true. And knowing that there's that much travel, okay, well, what I do is I keep my losses, small, and I just try to go and pick up the money when I can pick it up and minimize the number of losses I take and minimize the amount that I lose. I should be on top.
Right.
That's how you asked the question, how do you trade? Well, that's how I trade. I'm looking to pick up those. I'm not looking to go and make 20 pip wins or 30 pip wins. That's not my game. That's not what I'm doing. I'm happy to pick up a 2 or a 3 pip win. I'm thrilled with that. And I'll just pick it up and just stack them up.
Right.
And I know that I'm going to take some losses, but what do I do with that? I go and try to minimize those losses any way I can. Get out of the trade, average in if you really think that the trade is still good. Whatever is necessary to go and do it, but just keep yourself within the bounds of your game. In other words, don't violate the rules of how much you're willing to lose on any particular trade and how much you're willing to lose on any particular day. Keep yourself within those rules, and in the long run, you should be good. Are you going to have bad days? Yes, you are. Absolutely. You're going to have bad days. Are you going to have good days? Yes, you are. You'll have some really good days. But the thing is, if you keep yourself within those bounds, you'll never have a really bad day. And the reason why is because if you stay within the bounds of you're not willing to lose anything more than you're willing to lose on any particular trade, and you're not willing, and you go and make sure that you never lose more than anything that you're willing to lose on any particular day, you can't have a really bad day. You can have a bad day, but not a really bad day.
Yeah, that's true. And so I think what we're going to have to explore is, after the entry, because I mean, before the entry, you're looking for an entry, but and the thing is, you don't lose. There's no chance of losing. It's only after you press that enter key, enter the trade, that now you have a chance of losing.
Right. You're exactly right.
Right.
Yeah. Right now, I'm not in any trades. I'm completely flat. I can't lose any money.
Right.
I just can't. It's not possible. Not until I go and press either the buy or the sell button. And so until that moment in time, I'm in no danger.
Yeah. So, fellow traders, I hope maybe you've gleaned something from our little discussion today. And once again, the fastest 15 minutes trading's almost up. So, when you sit down at your trading platform, always remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. I actually maybe, drain the banks is only really good for the Forex market because when you're trading stocks or commodities, um, metals, you're not really draining the bank. So go out there and take somebody else's money. This is the Rumpled One over and out.